The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
Talking about the markets this morning and what's driving stock market returns, not just currently. We've done pieces on the Magnificent Seven and what's kind of moving the market these days in particular. But the 40,000 foot view, a longer time frame, we want to look at what's going on. There are certain people that still believe that we're kind of looking at a casino here, and the stock market is, some people win, everybody else loses. Everything's manipulated by the Fed. The results aren't real. Everything's faked. And if it wasn't for all the government bailouts or interest rates going up or down, or government spending, or the Taylor Swift concert tour, everything would have collapsed by now. Everything would have it's a house of cards. There's nothing real here. And we're going to go through that this morning and see if we think that's the case, which, spoiler alert, we don't think that's the case. We do have a number of checks and balances built into our system, both in the economy and in the stock market. For instance, there are circuit breakers built into the market now, to slow things down if there's a large run on the market. And they've worked pretty well when they've been needed, and they haven't been needed very often, which is even a better sign that markets are working pretty well. And so there's always going to be checks and balances in the system. There is no politician or government official that would want to allow the financial system at large to implode if they had any way of saving it. I mean, that's how they get their money, and that's how they get to spend it. They'd never want that to happen. So they're going to protect the system at all costs, which is good for everyone involved. It doesn't mean they don't make mistakes in it. Sometimes they do, but they're not actively trying to bring it down at any point. And it's kind of ridiculous to assume that it means the gains in the stock market are somehow rigged or fake. There is no man behind the curtain pulling levers to make sure that stocks just go up. There are days, of course, we wish that were true. We wish there was somebody, but there's just not someone there. There's nobody there making sure that the markets move up or down. They're still largely free markets in the United States. In fact, over the long run, fundamentals still play a very important role in the stock market success. We're technical advisors at Investor Resources. We watch charts, prices, all kinds of metrics that change as the market unfolds, so we can get an idea of where we should be allocating our clients' capital. But we still watch fundamental metrics of the economy and of the market to maintain some historical context of where we are and where we may be heading. And here's a good example right here. Check out this chart of earnings of the S&P 500 going back to the end of World War II. And so the green line is the S&P. The blue line is trailing reported earnings. So this is not estimates. That's the real earnings that came in. And there have been times when prices are ahead of earnings, and there are times when earnings are ahead of prices. But in general, the stock market's going up because earnings have been going up. Companies they've earned more money. The company becomes more valuable as it increases in size. So investors will pay more for a share of ownership, hoping that this process will continue to repeat itself in their favor. So the market's going up because the companies in the market are physically making more money. Things can interrupt that, of course. This is the great financial crisis. Earnings, dropped off the table. Still comes back, and over the longer run, we get that nice increase because companies are making more money. Another myth is that all the gains are due to multiple expansion. That's a big one. And while it's true, company valuations have slowly rising over time as markets have gotten safer, but multiple expansion has probably played a much smaller role than most people assume. We're talking about, what it costs you to get in and out, to buy and to sell, and then every year, what's the profit margin, EBITDA? You see that thrown around, that acronym thrown around, especially if you're watching any financial cable network. And this is earnings before interest, taxes, depreciation, and amortization. It's a core corporate profitability reading. So they want to know, are we at the base of your company? Are we making more or less? And then how much does it cost to get in and out of your company or the market as a whole, if you're looking at in general? And that's the multiple expansion. And while that has been increasing, as we just saw, earnings are much more important. So this is not just a function of, well, it costs more because we're paying more and that's the way it works. It's just that would be a house of cards, and that's not how it's been working. This is the late, great John Bogle. He had a very simple formula for expected returns in the stock market. Expected returns equal the dividend yield, there's another input, earnings growth, and then plus or minus the PE ratio, the price earnings ratio. And Mr. Bogle applied this formula to every decade in the stock market, going back to the turn of the 20th century, to see how well that these fundamental expectations kind of matched up with actual returns. And in his opinion, the difference between what this formula predicted and what actually happened was probably human emotion. And we agree with that part. Humans, we can mess up any system, and fear and greed are always in there to make people make decisions that they wouldn't ordinarily make. This is the chart of those predictions. Mr. Bogle died in the 2000s, and this chart they've been continued to update it. This is updated through the end of 2023, and it's again a very simple formula, and you can see that it's not, these are annual returns for the decade. So in the 2010s and the 2020s, we didn't have 11 to 13% every year. Some of those years were up and down. And then in the 80s and 90s, of course, we had huge, especially in the 90s, the run up in the 90s to the involving the tech bubble were huge. We had multiple 35% years and more, especially during portions of the year. So we did get some multiple expansion in there, but it always comes back. It always comes back to reality at some point. And so this has been a pretty good indicator of what kind of a market we're in, what kind of returns are possible out there. And so earnings growth has been one of the main drivers of stock market returns, as well as one of the primary explanations of market returns. So it's not as big a mystery as people will make out on a day-to-day basis. In a little larger context, it's pretty easy to see what's going on in the big picture. It's important to get dividends in there. Dividend yields recently, in the recent decades, have been fairly low, but the growth in dividends, especially lately, has been pretty healthy. S&P 500 dividends grew at an annual average growth rate of about 3% in the 2000s. And that's well below the historical average of more than 5%. So it was definitely down. But since 2010, dividends have been going up more than 8% a year. So dividends and earnings growth have been strong, and so is the stock market. So there's definitely a connection there. Again, that's another input. How's the dividends doing into what market returns look like? And it gives us another reason to say that our market returns have fundamental underpinnings that are real. They're based on dollars and cents going in and out of the market, and it's not completely it's not just a casino ruled by emotion. That's not the whole story. Another reason returns have been so stellar in the US is that US corporations especially are just so much more efficient now. Just look at that uptrend this is profit margins of the S&P 500. And again, while they are definitely negatively affected by significant recessions, they keep returning, and they keep. This is the the Q4 of 2023. So even after all the COVID response, where those margins are returning. There used to be an idea that profit margins were the most mean reverting time series of data in all of finance because of competition and capitalism. We were constantly going to be eating profit margin because it was going to be tougher and tougher to beat the next person's company. And technology stocks have pretty much put that idea to rest. Margins went up, they continue to go up. And even though they do have significant drawdowns, especially during recessions, they never revert back to the previous average. This is going back to the widespread distribution of the internet in business, 1995, and we have seen a steady increase in profit margins. This one chart really helps explain the dominance of U.S. stock over the rest of the world in the past 15 years. We just are becoming more and more efficient, and it's increasing profit margins, not decreasing them. So there's that constant fear that technology is going to wipe out companies, and it certainly is going to change the way things work. But it's very good for the companies that find a way to harness that technology and use it. It's very, very profitable going forward. Another reason the market continues to accelerate. The stock market has been good in part because fundamentals have been very, very good. There are other factors at play, but that really is the simplest explanation. It's worth noting that stock markets prices are always going to be far more volatile than the fundamentals, especially in the short run. The stock market is forward-looking always, but that doesn't mean it knows how to forecast what's coming up right next. It really doesn't know. The market needs a little more time to digest what's going on, pick winners and losers, buy who can attract the money. And so the prices move around a lot more than earnings or dividends, mostly because of those two primary factors, fear and greed. And this graphic shows them nicely balanced. Rarely does that occur either. Usually everybody's too scared to own anything or irrationally selling everything, or we have irrational exuberance, which we've all heard about, and greed kicks in and it doesn't matter what's out there, somebody's buying it. So it really is important to have a process to go through all of that data and all of these emotions which run the market. That's one of the ways we think we add value to the portfolio management process. We try to steer clear of large market moves that appear to be driven just by fear and greed and are especially very short term. We especially look out for significant market drawdowns. We really try not to participate in those to the greatest extent we can. We will gladly just step aside, take a cash position, and wait for the market to return to some normalcy, and we can find where that cash flow is, where we're heading, and then we'll get back in. It makes so much more sense than just hanging around, especially when things get so out of sorts at times. Sometimes with the help of Uncle Sam, when the government intervenes, we almost always get market dislocations that make no sense, and then we have bad reactions to what those markets are doing, and it feeds on itself for a bit. And we try not to get caught up in those, because you can lose sight of what you're trying to do. You can also lose sight of what the market's actually doing, and you begin to make bad decisions. In the long run, fundamentals tend to win out. The fundamentals of the U.S. stock market have been exceptional over the long run, and so have equity returns here. And it's because we still have the freest markets on the planet, as well as the safest. Sometimes it doesn't feel that way here, especially on the market freedom side, that we seem to be trying to eat away at that from time to time. But more often than not, we let markets dictate the direction that they're going to take for the most part. We've seen, again, significant market interference from our government at times. Just most recently, take all the COVID craziness where we pretty much closed the economy, and it happened around the world. Everybody shut down together. But they end up getting out of the way, and the markets recover because of the resilience of that much money and that many people acting in their own enlightened self-interest to keep everything moving in a good direction for as long as possible. And, you know, in America, fortunately for us, we can still invest, you know, most anywhere in the world that we choose to. But these days, mostly we choose to keep the money here at home. And if that changes, you know, so will we. We're not against international markets at all, of course. It's just this is not the time for large allocations out of the country. And as long as our fundamentals stay strong and investors from around the world keep the money flowing into our markets, we're going to continue to have US-centric investments. And that works well for us. It works well for our clients.